Hey everybody, welcome to the chronologically, the second video of my accounting series. Again, this is going to cover both year 11 and year 12. And I know previously I said, hey, theory, big, important thing. This time it's going to be balanced off, pun intended, by doing a balance sheet and by extension, the accounting equation, because everything we do in terms of practical work is held together by that. So I'm going to start off with a quick quote. I'm going to talk about it at the end, but while you're doing this, I do want you to think about the quote. It is perfectly balanced as all things should be. I want you to think about that quote just while we're doing this work, and I'll talk about it at the end, sort of as a wrapping up. Obviously, we're going to do a bit of a theory question as well at the end, but basically, I'm going to break this into accounting equation and then balance sheet, and this is form the basis. We're always going to come back to the balance sheet. I want that to be remembered, so we're always going to be building on that, but I want the basic form done here. So let's start. Our accounting equation is assets equals liabilities plus owner's equity. Now, if we go back to the previous video, link in the description, you should totally watch it. We know our definitions. We know what an asset is. We know our liabilities. We know what an owner's equity, or what makes owner's equity. We know all that. And this is where we do our application, or our up and down. So on the screen now, I've got 3 transactions. They're very basic. These are very bare bones. The first is we purchased inventory for $5,000 cash. So we used our cash to buy inventory. The owner contributed $1,000 cash. And lastly, we received a loan of $10,000. So what do each of those mean? And how do we ensure our balance sheet stays balanced doing these? So I guess the biggest tip I can encourage you is one transaction at a time. When you're given a list, always do one, make sure you've done that, then do the second, then make sure it's done, third, and so on. I think that's the easiest way, and I'm going to demonstrate that here. So the first one, we're going to have purchasing inventory for $5,000 cash. So what we know is we receive inventory. We're going to sell that inventory later. That means, hey, inventory up $5,000. Now, what did we use to acquire it? Did we get it on credit or did we pay cash for it? We paid cash for it. So, bank. Now, bank is always, for the purpose of the accounting equation, bank is always an asset. And so we pay cash, bank goes down $5,000. That's where that falls in. So in the asset column, you're going to have up inventory $5,000, down bank $5,000, and then liabilities, owner's equity are going to be blank. Now, as a little tidbit reminder, if something is blank, put a line there to signify you know nothing goes there. If you leave it blank, it appears you don't know anything at all. Put a dash there, or a line, or NA, or whatever. It demonstrates, hey, I know nothing goes here, okay? And that'll be on, that's like, you'll see I've done that. And it's just one of those little indicators. You can also write no effect as well. I think that's also a nice one. I do a dash, no effect, same end result. Owner contributes $1,000 cash. This time we receive cash, and it's up bank $1,000. And it's not a liability, it's not a debt, so it's owner's equity, because the owner's share in the business is going up capital $1,000. And you can see up 1,000 equals 0 or nil or no effect, plus up 1,000, your net result is both sides go up by $1,000. So it's balanced here. And then lastly, loan of $10,000 received. Our bank, because we received cash, will go up $10,000. loan is something we need to pay back in the future, and therefore that goes up by $10,000. And again, our owner's equity, no effect or dash. And you see right then and there, that's all balanced. Everything is perfectly balanced as it should be. So if you were to make a balance sheet of those just 3 transactions, your balance sheet would add up because your accounting equation added up. Obviously, if it goes up, you add it on. If it goes down, you minus it. So that's the accounting equation. That's the most simplistic form. We do more complex transactions. Like, I think the most complex thing you see in year 11 or for year 11, the most complex thing you would see is cash and credit sales with inventory. For year 12, it's a lot more along the lines of accrued prepaid wages and how those interact with expenses as a whole. But we'll cross those bridges when we come to them in the respective chapters and respective videos. Moving forward, I've got essentially an unclassified balance sheet. I know it's very rough, it's raw. You've got on the asset side, assets as a whole, the bank for $20,000, car for $8,000, accounts receivable $15,000, inventory $12,000, and shelving $32,000, with a total assets of $85,000. Meanwhile, on the equity side, you've only got loan and capital has a question mark. So when we do this, when we need to make a fully classified balance sheet, so we always will be making classified balance sheets. A classified balance sheet is your capital, your current and your non-current assets or liabilities. It's classified them to tell owners or users of your reports more information, and it helps with their decision making, ergo achieving characteristics. So what we need to do when we're making these balance sheets, the very first thing is we need to calculate capital, and there's a nice simple way. Now, A equals L plus OE. That means total assets is 85,000, therefore total equities, L and OE, also needs to be 85,000. That's balanced, or left equals right if you're in year 12. We know they're balanced. So what do we do? Quite simply, we know loan plus capital equals equities, so you can change that to capital equals equities minus loan, and you would get 85,000 minus 42,000 gives you 43,000. So on your paper, if this was in front of you, in that question mark, you would write 43,000. You may even be given a question worth 1 mark to calculate that. If you do, make sure you write it in the square, please. I encourage you, please write it in the square. It makes your day, my day, a lot easier. And next, what we do. So we're going to start with the asset side. All we're going to do is current, non-current. For me personally, if it's a current asset, I write CA. If it's a non-current asset, I write NCA. Now, you can do it your own way. You can write N and C, NCC, however you want to do it. Some people write the full thing, power to you if you want to. I do NCA and CA. Some do NC, C. So, again, your choice how this works. But I'll go through each item, and we're just going to talk it out. Now, we know the asset side is correct. We know the liability side is correct. We already know that. So we don't need to swap sides or anything. So, bank. I think that's a current asset because we're using it within the next year. So it meets the definition of current. But if we look at a car, we're expected to use a car most likely beyond that year. Accounts receivable, we want to receive our money back straight away. Ergo, it needs to be current. Inventory, we want to sell this as quickly as possible. So that, again, is current. And then shelving, we expect to have the shelving with us for a long time, most likely beyond 1 year. So it is non-current because we can use it into the future. Now, loan's a really interesting one. So on the screen, you're going to see the calculations for loan. So when we calculate loan, we need to get it per year. Now, currently, the loan is $1,000 per month. We need to get to a year, 12 months in a year. 1,000 times 12 is 42. 1,000 by 12 is 12,000. And of that 42,000, 12,000 of it is current, 30,000 is non-current. So that means in our balance sheet, in the current section, it's going to say 12,000. In the non-current section, it's going to say 30,000. And then capital is in the owner's equity section as 43,000. Now, some things to note just while you have a look here, just a little bit of a sidebar, is formatting. One of the big things is understandability on these reports, and I remember bringing up the Telstra reports on the first video, and I'll have them here just quickly. You can see a nice, easily format. You can understand it. What you can understand, you see this is what's happening. Now, if we look at the reports for this exercise, we see that on the left column, and we're going to use current assets as the big focus, we see on the left column, current assets, each line's filled out. But on the right column for current assets, it's only a subtotal. Now, because it's a subtotal, it gives an overall summary. So if I was to pick up that report, I know, they have 47,000 in current assets, or assets they can use within a year. I know long-term assets, they've only got 38,000. You can make more judgments, more decisions with that information. Because, for example, let's say that bank 20,000 was instead a non-current asset and it was a van. That changes how you view that business. Is it more of a risk or less of a risk? That's something an investor would need, or anyone who uses a report would need to make that decision. Other interesting thing, if we have a look at the loan, we can see it adds up to 42,000. Referring back to what we did, we see loan 42,000. So it adds up, but it's split out based on what we're paying within the year and beyond that year. So loan is just one of those things. It will take practice. Now, interesting starting point, and I think one of the questions that does come up at least once a year, justify your treatment of whatever item comes up. At some point in year 11, it's going to be justify your treatment of the loan account. And you need to say what you've classified the loan as and why. So let's go to our format. Let's go to what we've done previously. We know you need to say what it is or identify. You need to explain what that term is, and you need to link it. So you got to do those three things. But here in the loan, you need to do it twice. So it's 5 steps here. So you're identifying both current and non-current liabilities. You're saying what both are. You're linking both here. So for example, I would say it's a current liability because you need to pay 12,000 within next year, but it's also a non-current liability because you need to begin making those payments beyond 1 year. And that 30,000 is not due until a year after. So that's where that would come in, and you can get any of those. You might get justify your treatment of the GST account, justify your treatment of the bank, inventory, car. It can be anything, accounts payable. You've got those options. So back on to that quote. Perfectly balanced as all things should be. That quote was amazingly by Thanos, who was trying to balance the universe. And I feel like for accounting, we're trying to balance the books, And we don't move on until we've balanced the previous transaction. And I think that's a good mindset you need to get yourself into. Balance the book, balance that transaction, and then move on. Too often, people try to skip ahead. So, on that note, please remember the theory structure. Please remember one transaction at a time. And please be aware of what makes a current and a non-current asset and liability. These come with practice, but the more practice you do, the better you will get. Anyway, thank you for watching. Please click the follow, subscribe, share with your friends if they do accounting. The more people that see this resource, the better it is, because people want to do accounting and we need nice resources. So, thanks for watching, and I will see you next time.